Another housing debrief. This is Stephen Thomas with Reports on Housing coming to you live on this Thursday afternoon. A lot going on right now, and just had to wanted to bring you the latest and greatest. So, without further ado, let's go ahead and get started. And of course, forgot to share the screen. Always something, right? Anyhow, here we go. All right. So here we are, another house debrief already. Season 4, episode 3. It's third week in a row. Here we go. And let's see. So we've got. I want everybody to like like these videos and subscribe to Reports on Housing so we can disseminate all the good information out there so that people can make some very good sound choices and armed and equipped with all the facts and data necessary in order to make those great choices. Not just all the hearsay and what do you think type of things from people that aren't dialed into what's really going on in the housing market. And keep in mind, I'm not just looking at housing analytics. We're looking at housing analytics from around the world and across the United States and everything else that goes into this fun thing. So rates are rising again. And big, giant change from 2 weeks ago to where we are today. It's hard to believe that it's been this big of a change, but really wanted to address what's since the last time we spoke, and big change from a couple weeks ago. Because you have to understand, here we were, rates were going down, and they were headed down after reaching up into the sevens, both in October and November. And the last time we were above 7% was at the very, very start of November, prior to Thanksgiving. So let's see. Where are we? Hang on. Where are we headed? Well, on February 2nd, we were at 5.99%. It was hard to believe that we hit underneath the 6%. Everything was looking good. Everything from December, we had great inflation reads. We had all the things that showed what the Federal Reserve wants to see, and that is that the overall economy is starting to cool. And it's not plunging, but it was cooling enough where it showed a nice solid trend that would be helpful for the continuing story and saga of inflation coming down. But then along came, right after we had that was we had 5.99%, hit it for a minute on Thursday. The following day, on Friday, February 3rd, we had a jobs report. They call it JOLTS data, and it comes out on a monthly basis. So typically the first Friday of the month. So we got that Friday, can't even say it, Friday, February 3rd. Anyways, we hit this January of 517,000 jobs. This was way higher than expectations. And let's keep on talking about what expectations were. So expectations were this was supposed to be well under 200,000, and yet it was at 517,000. As well as the unemployment rate was over here at 3.4%. Well, if you draw a line across, the last time we were there, I was brand new baby boy, 1969. It was like May of 1969, the last time we had an unemployment level at 3.4%. And right after this came out, we saw that interest rates went up that Friday. They also, after the weekend, interest rates continued to go up on Monday and Tuesday. They kept going up. And as a result, by the time we got to February 7th, we had gone from 5.99% all the way up to 6.45% in just a few days. So now we're dealing with a much higher mortgage rate than everybody had been accustomed to just for a short period of time. So here we dot it back up. So Neil Kashkari, we talked about him last week, but I do want to remind you that what was asked of him is, well, with his job report, what do you think? And he said, we're going to have to use some tools. And they say, what do you mean? And he just said, we need to do more with the federal funds rate. Now, know that that we constantly hear every other month that they're changing the federal funds rate, it's going higher. That was already baked into the system as to where all investors on Wall Street think that they're going to be long term at where they're going to stop. And that's important because where they're going to stop is called the terminal rate, and that's what they thought. Everybody thought that they were going to do all the recent rate hikes, including the one on February 1st. That was already baked into the system, and as well as another one that's coming up in March of 0.25%. Now, so that's where everybody thought that it could be. Now, however, now we're starting to think that it's going to be a bit higher. Not we, but all the investors are out there saying, hey, you know what? The Fed has a point. They might have to continue to go up even higher than what they had originally said that they were going to go as. And they come out every quarter and they say, this is how high we're going to go. And then they say, wait a minute, this is how high we're going to go. Oh, wait a minute, this is how high we're going to go. And that's what happened last year. It kept on ratcheting higher and higher. So this is what Neil said, that we need to do more with the federal funds rate. The consumer price index came out, and that was out this week. Last week, there wasn't a lot that happened. We were all digesting the jobs report, but this week there was a lot of economic reports that came out. So consumer price index came out on February 14th, and know that the consumer price index it came out. It was too hot. It was down a bit, but you could see the velocity. It says 6.4%. It was supposed to be down a little bit more than that, as well as the core, which is taking out the volatility of fuel as well as food. And you take out the volatility, and this is the inflation read. This inflation read came in a little bit hotter. Yes, it was going down, but it wasn't going down at the clip that everybody thought. As a matter of fact, this is 6.4%. That was what they called the headline inflation, and that was supposed to everybody thought that was what the sentiment was out there was supposed to be 6.2%. And then the core was supposed to be at 5.6%, and instead was at 5.5%. Now, both of these were hotter than expectations. Again, expectations. We're talking twice where expectations where it came in a bit hotter than what everybody anticipated. So after that inflation read came out on the 14th, that was just a couple of days ago, here we go. Rates start to rise again. And here on February 14th, we were at 6.62%. Now it continues to climb up. Then along came yesterday, retail sales. That was February 15th. Retail sales, a gauge of all retail spending, and retail sales climbed at a pretty high clip after a December fall, and they were saying how the holidays, how everything was down a little bit, and it was better than, or it was lower than what they even had anticipated, which was all good for the inflation story of trying to get inflation under check. Now, it was up 3%. So that is a big, giant change, being up 3%. So it was expected to be up 1.9%. Now, that is 3% is a lot higher than the 1.9% expectation. So this was also a much bigger report than what people were anticipating. And you can also see it here in where everybody likes to go out to dinner and to go to the local bar, the local pub, and just to unwind. Well, if you look on the right-hand side, it says that you could see that spike. People are going out to eat more as well. So just another inflation read. As a result, yesterday we had interest rates continue to jump higher, and yesterday we were at 6.75%. Remember, just 2 weeks ago today, we were at 5.99%. Now we're at 6.75%, 0.75% higher. And then today, not as many people follow it. I know that the Fed watches it. We all in economics land watch it. It's PPI. It's the Producer Price Index. This goes into making all those goods happen, so that when the retailer goes out and they sell them, if it's going to cost more to make stuff, you know what, that's a problem. And today it came out, and it too, PPI was at 6% versus the core, which takes out the volatility once again, and that was at 5.4%. But now the PPI, the headline was supposed to be at 6. The expectations were 5.4. Instead, it was at 6. The core was expectations at 4.9. Instead, was at 5.4. So once again, much hotter than expectations. So all these reports combined created a pretty hot environment for mortgage rates. And as a result, mortgage rates today continue to go up, and they're at 6.78%. Now, we went from the 5.99 to 6.78%. That is a big shift in a very short period of time, very reminiscent of last year. And what the overall picture is, that in spite of the fact that the short-term rates have gone up as much as they have, and housing has slowed as much as it has, it doesn't matter. The overall economy is still coming in too hot, and everybody knows that the Fed needs to fight inflation. And all these investors are on board with, hey, you know what? The Fed might be right. They might have to continue to rise interest rates and change that federal funds rate. What we thought was the rate was going to be, they'll stop when they get to this next one right at 5%. They might have to go higher, maybe 5.5, maybe 5.75. So that is going to be something that we're going to listen to. And as they say more and more, and if the investors continue to believe it, we could see mortgage rates climb further up towards 7% or even higher than that. And as a matter of fact, here are two Fed presidents that came out today, James Bullard and Loretta Mester, that both talked about a 0.5% increase at their next meeting. They were both on board for a 0.5% increase last time, but now they're being vocal and loud about it. So it was making all the headlines today of where I'm listening to in economics land. And as a result, they're meeting again in the month of March. And it's not anticipated yet for a 0.5% increase, but we have more economic stuff to come. But right now, the argument is that it could really be on the table. And if that happens, that will exceed what everybody had originally thought that the Fed would do. And we could get higher long-term mortgage rates, because then all investors have to digest the fact that here was that ceiling that they thought that the Fed was going to have to go to and then stop. Now that ceiling, as it goes higher, it brings mortgage rates up higher as well. So inflation is what they are trying to control. Know that it will not go down in a snap. I'm of the camp where I said, this is still going down in the right direction. Does this surprise me? No. I said there'd be volatility going down. It won't be a straight down type of a trajectory. Instead, there will be some report, quite what everybody wants to see. So just as it took us 18 months for inflation to wind its way all the way up till we peaked last year, it's going to take a long time, could be 18 months from when this started going down in November to when it finally settles down to where the target is of where the Fed wants to be at 2%. So that takes time. We're talking not 2023, we're talking 2024 until we get there. So this really takes time to get there. And understand that inflation is really sticky, that it will come down. It just takes time. It does not happen overnight. So you're wondering, what in the world does all this have to do with these when will mortgage rates go down? And mortgage rates will start to go down when we start to see more evidence that the overall economy is cooling. So right now, based upon what we saw in this last week, it doesn't look like it's going to cool anytime soon. Do I think that this is going to be the way that it's going to unfold for the next several months? I actually don't. So, but we'll have to have more of those points come, those little data points come, so that we can make a better informed decision based upon everything we saw within the last week and a half. Everybody's going, oh my gosh, it's a lot hotter than it was. It's going to take time for this stuff to come down and work its way into the system. A lot of those federal funds rate changes have taken time. They take time to go through the system. It's going to take additional time for everything to work its way through the system and adequately slow the overall economy. So what about housing and these higher rates? Well, first, I'd like to bring in our sponsor, Just Appraisals Inc. You can go to justappraisalsinc.com and reach them at 949-939-5622. That's 949-939-5622. And they are a leading real estate appraisal company with over 20 years of experience. They're based in Orange County. They serve all surrounding counties, not just Orange County. They have a team of highly qualified and experienced appraisers, and they have a systematic approach towards appraisals. They provide high quality and a realistic evaluation and values to your property, and exceptional service and competitive fees. And they have date of death appraisals for real estate tax planning. They have divorce appraisals. They have private sales appraisals, and they have complex residential pre-listing appraisals. They pretty much cover what you need when it comes to appraisals. And they also deal with hard money lending for Fannie Mae, FHA, and VA loans. So you can go to justappraisalsinc.com. You can also contact Just Appraisals Inc. at 949-939-5622. That's 949-939-5622. Thanks for your sponsorship, Just Appraisals Inc. And let's get back to what's going on with housing. In Southern California active listing inventory, this is where, there they are. Whoop. But first, we're going to get into housing, overall housing market. Let's talk about low demand. Low demand has a lot to do with purchase applications too. You can see how low the demand is based upon the purchase applications on the right-hand side. We were a lot higher last year at this time. We're a lot lower right now. It's actually, within the last week, it was down 5% week over week. That's starting to absorb those higher interest rates where they were getting towards 6.5%. And they were down, it's down 43% year over year. It's going to be way off until we get to June anyways, but I'm just demonstrating how much less demand there is right now compared to last year at this time. Now, that is a big drop, that 5% drop week over week. We'll have to see next week what happens because mortgage rates have come up even higher. So this low demand is just a snapshot of the last 30 days worth of pending sales activity. And today it's at 11,041, which is 15% higher than it was 2 weeks ago, or an extra 1,423 pendings. And last year it was at 15,234, which is 38% higher. And the 3-year average is 15,177, which is 37% higher. And where do I think demand is going to go? Well, I think it's going to start to ebb a little bit, and it's still going to go below that the last year's yellow, brown, or that orange line. It'll go right below it, and then it should continue to go flat. And then from there, I think as we get higher rates, that was really quick. It's going to go. It's going to thread the needle right there. Maybe, just maybe, if we have too hot of an economy, it could follow last year. I don't think that's where it's going to go. I think it's going to be between the purple and orange lines. Now, we're going to match that really low demand level and understand that it fluctuates a lot. There aren't a lot of buyers in the marketplace. And if we start seeing interest rates come up, that demand pool shrinks, and it kind of matches this low supply pool that we have. We have a supply crisis going on. It got to the point where even the low demand matched up to this low supply was creating a little bit of heat. And we're getting the heat right now in the marketplace, but we'll have to see where we go from here. That it's probably going to slow now that we have these interest rates that are higher, and the buyers in the system aren't going to like seeing interest rates go from 6 to 6.75% in such a short period of time. And the inventory across the United States has dropped. It dropped 3% within the last week. This is not normal, where it shouldn't really be dropping at this time of the year, but it is, because this is a strange year where we have a lot of homeowners not placing their homes on the market because they're locked in at exceptionally low levels, as well as the overall inventory is down 4% within the last 2 weeks, down another almost 1,000 homes. Last year was 39% less, but it's squeezing. It's making its way towards last year at 12,000 701. The 3-year average is close to 34,000 homes, which is a lot more than where we are today, 63% more. So the overall speed of the market, it is getting hotter. And this is based upon, of course, the last 30 days worth of pending sales. I'm telling you right now, based upon what I'm seeing in the purchase application index, I'm expecting demand to abate a little bit and not continue to go up at the same trajectory that it was as more homes come on the market. So that means that it's not going to get any hotter than it is right now, and could slow from here as well. So we'll just have to see. But as far as the expected market time, place your home on the market. When are you opening up escrow? Today it's at 56 days. It dropped 12 days within the last 2 weeks period of time. And last year we were at 25 days at this time period. The 3-year average is 68 days. So it's well below that 3-year average prior to COVID. So that's 2017, 18, and 19. So where is it going to go from here? I think right now it's just going to stay flat. And then from there, it's going to go up slowly. So that's where I think it's going to go based upon where the market's at kind of right now. Now, if the market were, if the all of a sudden we were to get economic news where everything really is slowing, we could say that with the slowing economy, interest rates would come down, it would fuel demand, and as a result, we'd see the expected market time remain under that 60-day bar, that the threshold that I have on the screen there. So, hey, you want a copy of this? You need to be a subscriber to the Housing Report. Where can you go to subscribe? Reportsonhousing.com. You click there to subscribe. We have a whole bunch of reports that's all over SoCal. I'm right now almost finished with the Bay Area, and the most recent one is housing starting to flex. Even Riverside and San Bernardino got theirs this week. Next week, there will be a brand new report that comes out on Monday. I think I'm going to talk a lot about rates on Monday and the different avenues we can go down based upon where rates go. So look for that report coming this week. And you can subscribe $15 per month or $150 per year. The first month free if you utilize the same coupon code as last week, handcuffs. And that's because a lot of people have the golden handcuffs. They're homeowners with these low rates, so they're not placing their homes on the market. So that's all I have for you. I really appreciate you tuning in. And thank you so much for tuning into another housing debrief. I hope you have a fantastic finish to your week, and we will see you on the other side.